Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to rip through Twitter, see what people are talking about, go over wealth, go over commodities or financial topics. But that's kind of what I'm focused on. I think the opportunities in the markets are commodities right now because of where the ratios are at and where the value's at. So we do focus a lot on commodities on the channel. So I'm going to go in here. I'm going to give you my financial opinions as we go. We're going to go over a bunch of different topics, and I'm going to interject my opinions along with it. So let's dive in. Let's see what's going on with the pulse of the markets and what people are talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com, where we go over more individual companies. We go over topics from a more of a learning perspective. And we do have a 50% discount on the monthly membership for the first month. It is September coupon code. All right, so this is my post. Understanding where we are in the real estate cycle is very important. It determines how money flows from an asset to an asset. Where do you think we are in this cycle and why? And this is the real estate cycle in a circular format. You can see where a lot of these areas where people think where we're at. So a lot of people think we're in the middle of an expansion phase given all these areas. Some people think we're in a hyper supply phase for certain areas, and then others are early in their expansion phase here. And we even have some Little Rock all by itself in a recession. An expansion phase, so if you were to kind of go through this, an expansion phase is decreasing vacancy rates, moderate high new construction, high absorption, moderate to high employment growth, and median high rental rate growth. The majority of people chose the expansion side, and that is also where a lot of these areas are at. When people refer to late cycle, generally late cycle is a hyper supply phase like these blue areas. So if someone were to say we're real late cycle means we're over in hyper supply. I don't think we're in late cycle or as late as what most people think. One thing that is screwing up this cycle is the stimulus money that came into the system. It's artificial and it was a lot of money all in one shot. So we could be earlier than what we think. We may not even be in a hyper supply phase. We could be early expansion. But the problem is the housing market wasn't the driver of this movement in interest rates. It was mainly stimulus money that came in and pushed the interest rates to a level that may not be sustainable for the real estate market. And I think that's why everyone thinks this cycle is kind of weird. And I think they think it's weird because the real estate cycle, the real estate market is not driving the interest rate by itself. We have imbalances where the interest rates may have gone too far. And then if they go too far, we could also see problems in our bond market, which also amplifies the move in interest rates. So previous cycles, they were all driven by housing and the inflation from the housing market. This cycle, well, they threw that stimulus money in the beginning of it and they really punched it. They also held down interest rates for a while. And that's why the housing market took off so much. We were in an expansionary phase of real estate when they did this. They're definitely jacking with the system. They're jacking around with it. So I think we are in an expansion phase, and I think that interest rates could be a little too high for the real estate market compared to what it would be without the stimulus. I'll just say it that way. Moving on down, it says the U.S. is on course to complete construction on over 460,000 new apartment units in 2023, the highest figure on record. It says the U.S. is on course to build. Yep. So this is our 461,000, the highest on record. You can see we've been increasing our building ever since about 2012, 2013, all the way on up. Is this where it's going to peak out? I don't know. How many are we underbuilt? Doesn't say. We just say it just says this is how many are being constructed. And I know we need apartments, but how many single family homes? What does that look like? The cost curves for the cost to build single family homes has exploded to the upside. Our cost structure has really increased for single family homes. So even though people may prefer to live in a single family house, the cost to build them and the cost to replace single family homes is very expensive. And that is what's driving, I think, a lot of the home prices higher and away from the medium income. So when a lot of people, they'll put these medium income charts up, and it's not this one here, but they do, and they say, look at the price to median income. Guys, those people are going to be priced out forever. You can't, we can't make homes. Well, maybe we can make them small enough where we have 900 square foot homes that the median income can afford. I don't know. But if you look at the cost, basically your cost curve of homes, it's way up there. And it's about where the median price of a new home or an existing home is, new and existing homes. Here is the stock market. It says all employee construction's increasing, total construction spending is up, housing starts above average in an expansion phase of real estate, and total residential spending back on the rise. So all employees in construction, we are still increasing. This hasn't rolled over, didn't roll over and coming down, still going up. We have total construction spending going on up. We've got United States housing starts that are still above average and increasing slowly. And we've got total construction spending in residential. This did come back down, and now we're going back up again. So we do have that. Home builders still look great from a long-term perspective. A short-term pullback is possible, but would not disrupt the long-term outlook. Note, I know some will say it is a rising wedge formation on DHI, but I think it consolidated upwards over the recovery phase of real estate. So this is the recovery phase here as it consolidates. You break on out, and now we're starting to move higher. One could argue that we just broke out of the all-time high. We're at an all-time high. We just broke out of the high here to create an all-time high, did a retest, and we're starting to move higher. And that the expansion phase hasn't even really started that much. It really hasn't entered a hypersupply phase. Otherwise, we'd be way up there. And I think we will get up there. I think we've got a lot more room to run to the upside. That's Lender Corp, MTH Meritage Homes Corporation, sitting right on top of its breakout. Toll Brothers also broke out, making an all-time new high. And then DR Horton, DHI, coming on up, and it looks like we could be breaking to the upside at some point. Is this a rising wedge? We'll find out, guys. We'll find out. He says, good luck with the recession. And I hate to say it, but recessions, the housing market can cause a recession and not screw up the housing market. It may delay it or pull it back to some degree, but it won't crash it. The recessions are from the housing market crashing. And what you see is you'll see construction employees get laid off in construction, and that's your recession. If this continues to go up like it is, no recession. This is most likely my guess. Here's crude oil. Crude oil prices continue on the move to the upside. You can clearly see the consolidation from 2008 to 2020. Clear break and back test. Here's your consolidation in here, and then you've got a break, a back test, and now we're starting to move up into the new bull market. Here's other ones. Yields continue to be resilient and could have further upside to go. This is generally good for energy investments, 2-year and 10-year yields. The 2-year, it is still holding on quite a ways up there. 2-year, you can see we've got a downtrend break moving to the upside. This is your commodity bull market here. We've got the 10-year yield from a long-term perspective, rising interest rate, declining interest rate, and a break to a new paradigm of higher increasing interest rates. Here's the 10-year. Is this the Batman pattern? I don't know about that. We still have pretty good strength, and we'll see if this rolls over. It's going to have to roll over for me to claim the Batman. We've got XOP and PSCE sitting on top of the neckline of an inverted head and shoulders pattern. Here's your neckline. We're sitting right on top of it in an inverted head and shoulders. PSCE, inverted head and shoulders on top of the neckline. Two very good locations for energy investments. And then you've got Uranium and URNJ looking great. Hang it in there with little selling pressure. Still looks good for both of those. There we go. Tavi says the most active oil producing basin in the U.S. is now experiencing a contraction in the number of operating rigs. It is the largest 4-month decline since the COVID lockdowns. Keep in mind that this basin accounts for nearly 40% of all oil production in the United States. So operating rig count is a little bit lower in the Permian Basin. And I think this will eventually turn around. So I think the drillers are a good location. We just need higher oil prices to turn this all back around. It says, we believe this is just the beginning of a structural bull market in commodities stifle. And it goes into the reasons why. The rise of ESG, artificially elevated cost of capital, excess total returns in commodity-related equities going forward is what they think. We have uranium here, how I view an asset class with a long-term approach. I would be bullish since 2017 plus uranium physical pricing. Does this make me a perma bull? It doesn't. You should have a bullish mindset since 2017, a bearish mindset before it. Would this be obvious in 2017 to be bullish? No, it would have been a tough one to figure out. But by 2020, you should have said, okay, this is putting in higher lows. We should get long here. What I did. And I've been bullish ever since. So these pullbacks, people say, oh, what are you, a perma bull? What are you, a perma retard? I mean, look at this, guys. You should be a bull ever since this time going to the right side. So what do? I invest and I stay long. That's what I do. It's that simple. I'm a bull until this changes. That's how you make a buttload of money. You don't sit there and try to time it on the short term. You buy it and you sit in it and you just wait for it to appreciate. So that's what I would do. Current energy bull market is progressing nicely with recovery in 2020-21. Incredible outperformance in 2022 and a slight pullback and bounce in 23. Structural changes of OPEC back in driver's seat and U.S. shale growth behind us equals a major tailwinds as the cycle continues upwards. So these are the previous cycles. You can see 09 to 2014, pretty weak there. That's that greenish, ugly looking color. 60 to 69 has a pretty strong one. Notice how all these turn upward towards the end of the bull markets. They all have similar movements at the top. And if we were to look at this, this is where we are from March 2020 to 23. Now here's the thing, all right? This cycle was not driven by the real estate market. A lot of these other cycles were driven by the real estate market to some degree. And this might be a stimulus move. We have to reset, and then we go into what would be a real move from the real estate market. But that means that interest rates have to cycle back down for that to occur. That is a possibility. Or this is where we're at, and we're going to get a nice big move, and the real estate market's going to kick on again because of the shortages in the market. Why do I keep talking real estate cycle, and why is that important to oil? Because that's where the credit comes from. Credit could come from deficit spending, where it's fiscal driven. That is very well a possibility of a driver. But all these other cycles, they were generally driven by money coming from the real estate market. 99 to '08, 74 to 81, 60 to 69 was also a move in real estate, and 2020 to 2023 could be more stimulus driven in the beginning of this. U.S. total oil inventory declines were already remarkable last year. Here's your declines in inventory. That's what it looks like. Oh, yeah, that doesn't look bullish. Yeah, right. That looks incredibly bullish from an inventory perspective. And that's commercial and SPR. It's both. We have a major imbalance in the oil market. It says it's a mystery to me why the energy sector remains so hated and ignored. No other sector remotely comes close to comparing lowest debt and highest profitability, combined with the highest free cash flow in months away from 75 to 100% return of capital inflection. So here's exploration production companies, ridiculously priced. This is below their 10-year average and the return on equity above the 10-year average. This is like a dream for investors. And people are still ignoring it. They want to go play in tech stocks that are 200 times sales. NVIDIA. This is a really good location for value. We got Terry there. Goring and Rosenzweig. We believe significant exposure to physical precious metals and related equities should be considered. I agree, especially the physical part. How are builders thinking about next year? Build, build, build. What is your plan regarding housing starts in 2024? This is their plan. Roughly the same, up 1 to 5%, up 6 to 10%, up more than 10% compared to 2022. The majority up more than 10%. Are we in an expansion phase of real estate, and what do those people think about housing starts? They think they're going to build. We are in an expansionary phase of real estate. This is what's going to drive the credit expansion. This is why Powell has to keep rates higher for longer, or the market's going to force him to keep it high. And this is going to rotate money into our commodities. Everything is still game on, and we have not gone into a hypersupply phase yet. It's still very much game on for commodities. XAU versus world currency units. XAU is gold. So it says this chart's very clear on that gold is going higher. We've broken out. We've got a nice little flag pattern or so up here, and we could very easily move to the upside. He's got a parabolic move with at least 5 touches so far. Big changes go slow until it goes fast. This chart puts it into perspective that even without factoring in the cost of servicing the debt, fiscal spending alone represents over 25% of GDP in the U.S. Today's government expenditure has already surpassed the levels seen after the global financial crisis. So here is U.S. fiscal spending, excluding interest payments, as a percent of GDP. So interest payments aren't even in here. And you can see that we've basically broken out and come on back, and we're starting to head higher again. That's that fiscal. When I talked about inflation, this is the fiscal side of that inflation. Posted that the orange backtest for oil would most likely hold, and it did. So he's thinking, he's like me. Grady is very close to me. He says oil rising again, another second inflationary phase is starting. And oil rising often starts off recessions. At least 250, 300 oil during this bull market. Commodities bulls, a lifetime of opportunities. Shoulder, head, shoulder, the move lower. Then we've bounced on up, wave 1, wave 2, and then we'll move all the way on up. It's going to be big. I agree, Grady. Here's gold. Shoulder, head, shoulder, inverted. And we could easily be breaking out at some point. I know people get very impatient Now's not the time to be impatient. Now's the time to exercise the most amount of patience that you can endure. As these things work themselves out, big moves are ahead. Now, this one's already up here. We're already doing this other move here because we're over here in 2023, and we're gonna rip this thing. This is silver to platinum ratio is in a huge price range. Now up against yellow resistance line again, with both metals close to mega breakouts on their monthly charts. It will be interesting to see which of these very potent metal will take the lead. And we've seen them pull back here recently, both silver and platinum, and they're actually at very good areas to accumulate again. Very good areas. Don't let these areas pass you by. Accumulate them and just hold on and be ultra patient. It's coming. It says when the price ratio moves up, silver outperforms platinum and vice versa. Been moving back and forth. GDX versus GDXJ versus GDX. And when we start to see GDXJ outperform GDX, that's when we start to go into a bull market. This ratio chart shows the smaller gold miners have broken out versus larger ones. This is what we want to see, and it means the more speculative, smaller stocks are starting to outperform the larger stocks. It means the market is buying more risk. Here is KB Home CEO Jeff Mesger. Housing market inventory is so scarce that builders will be in the driver's seat for years to come. A chunk of that resale inventory isn't even livable. The housing market inventory is so scarce that builders will be, yeah. And this is what it looks like, guys. The red is underbuilt areas. Yeah, that looks really overbuilt there, guys. And we're in the middle of an expansion phase of real estate. And it will be like that for probably the next 5 or 10 years, even. Probably 5 years. I know some people, they really look at the length of the market as 18.6 years. 18.6 years puts us at a peak of about 2026. I don't know if we can build the amount of homes needed for the market in that time frame. And that depends how expensive they are too. But I think that we have at least 3 more years. It could be even 5 more years or longer, depending on how fast they build. Commodity prices have reached one of the lowest levels of undervaluation relative to the Dow Jones Industrial in history. Are commodities due for a run to what we saw in 1970s? Yes, we are. This is what happens, guys. All right, let's look at this real quick. The 40-year decline in interest rates started in 1980, and we worked our way lower all the way down to the bottom here. So this here is a downward move in commodities to stock ratio all the way down to the bottom here. What I think is coming is, see how long this rounded bottom was in the 60s and 70s? This lasted a decade, 60 to 1970. It was down here for a decade, and then we launched to the upside. We have been down here since about 2018, 17, and we could round out this bottom, and then we just rocket to the upside. A gigantic shift of money comes right into commodities. So you just have to sit in it and be patient, and all of the wealth will come, I think, in a pretty short period of time when the money rotates. Now, when is that exactly going to occur? I don't think that's the right question to ask because no one knows that. We know that we're cheap. We know that we're improving to the upside, and now's the time to be patient and just wait for that rotation to occur. Find your companies, accumulate the companies. They're all putting in those bottoming patterns that I talked about above. Inverted head and shoulders for all the energy companies and energy service companies. Uranium looks fantastic. It's all underway. It is all underway. Here it is. URNJ. You can see this is rounding up, and we're starting to move on to the upside. It's all underway, guys. This is uranium versus the S&P 500. Downward momentum, sideways momentum, and here we are breaking to the upside for uranium outperforming the S&P 500. It's all coming, and the S&P could fall down. It could go lower while commodities go up, and we draw currency from those sectors. So that's what I've got for today, guys. That's where I'll end it. Thumb up for the content. Subscribe to the channel. If you guys want, you can check out the website with that discount. September is the coupon code, 50% off for the monthly membership if you want to try it out. And then you can get a bigger discount if you want to sign up for the yearly. It's a bigger discount. So that's what we've got, and we'll catch you guys later. This is Finding Value.